Hey everyone, and welcome back. We spend a lot of time here talking about ways to really make the most of your real estate investments, right?
Absolutely. Every dollar counts, especially when you're just starting to build your portfolio.
For sure. And today we're going to deep dive into a strategy that honestly I think is often overlooked, especially by newer investors. And it all comes down to taxes.
Ah, yes. Taxes. Can't avoid them.
Nope, no escaping those.
Yeah.
But you can definitely be smarter about how you navigate them, especially as a real estate owner. So have you ever heard of the term cost segregation?
I'd wager many folks out there might not have. Or maybe they've heard it in passing, but never really understood what it's all about.
That's exactly why we're digging into this today. It's a
Yeah.
really powerful tool, even if you're just starting out with, say, one or two rental properties.
It can be a real game changer. Basically, cost segregation lets you break down your investment property into its various components, things like plumbing systems, appliances, landscaping, and depreciate those individual parts at faster rates than you would if you just looked at the property as a whole.
Okay, so before we get lost in the weeds here, let's back up a bit. For those who are completely new to this, can you give us like a real simple definition of what cost segregation is? Like, what's the elevator pitch?
Sure. At its core, cost segregation is a way to strategically categorize the different parts of your property, like the building itself, the land, and all the stuff inside, so you can take advantage of faster depreciation. This translates to bigger tax deductions up front, which can seriously boost your cash flow, especially in those early years when you're building momentum.
Got it.
Yeah.
So instead of lumping everything together and depreciating it over, 27 and a half years for residential properties, 39 for commercial?
You got it. Cost segregation lets you break things down. So maybe your fancy new HVAC system gets depreciated over, say, 15 years, or even shorter for things like appliances or carpeting. Those might be 5 or 7 years.
So you're essentially recognizing that not everything in a property wears out at the same rate.
Right.
Some things need replacing way sooner than others.
That's the gist. And the IRS actually allows you to account for that through cost segregation. Now, I'm sure our listeners are already thinking, okay, this sounds great, but how does it actually work in practice?
Yeah, walk us through the process. What does it look like to actually implement this cost segregation thing?
All right, so there are a few key steps. First up is what we call asset classification. You basically need to go through and meticulously categorize all the different components of your property. Think of it like taking inventory, but on a much more detailed level. We're talking plumbing fixtures, electrical systems, appliances, landscaping, you name it. Anything that's not inherently part of the building structure itself.
So you're basically dissecting the property and figuring out what goes where, depreciation-wise. Sounds kind of complicated, honestly.
It can be pretty detailed. That's why you typically need to bring in a qualified professional to do this, someone who has expertise in both engineering and tax, because you need to understand both the physical aspects of the property and how those translate into tax regulations. They'll go through your property documents, things like blueprints, contractor invoices, even appliance manuals to make sure everything is classified correctly.
Okay, so you're not just winging it. There's a real method to the madness.
Precisely. You want to make sure your cost segregation study is accurate and defensible if the IRS ever comes knocking. The second step is applying all those fancy accelerated depreciation rates. So once everything is categorized, you can start claiming larger deductions right from the get-go because those assets are depreciating over shorter time frames. And that, my friend, is where the magic happens.
That's where we see those big, beautiful tax savings and that extra cash flow that makes real estate investing so rewarding, right?
You got it. It can make a huge difference.
Now, you mentioned bringing in a pro, and I'm sure that comes with a price tag. So who exactly can benefit from this? Is it worth it for, say, a smaller investor who just owns one or two rentals?
Great question. While it's certainly popular with big commercial projects and folks with massive portfolios, cost segregation can definitely benefit smaller investors as well. In fact, it's particularly valuable if you've recently purchased or renovated a property, even if it's a single-family home.
Okay, that's good to know, because a lot of our listeners are in that exact boat.
Yeah.
What about folks who aren't considered real estate professionals by the IRS? Those with regular day jobs who are also managing a rental or two on the side.
That's actually where things can get a little tricky. The IRS has these rules about passive activity losses, basically meaning that if your rental income is considered passive, which it often is for those who aren't real estate pros, the amount of loss you can deduct each year might be limited.
Ah, so those big deductions from accelerated depreciation might not be fully realized right away.
Right. They might be carried forward and used to offset future passive income or even gains when you eventually sell the property. But there's a bright spot: bonus depreciation.
That sounds promising. Tell me more.
Okay, so for certain assets, like those with a lifespan of 20 years or less, think appliances, landscaping, stuff like that, current tax law often lets you deduct a huge chunk, sometimes even the entire cost, right in the first year. And this applies even if you're not a real estate professional.
So that's a serious advantage, even if those passive activity loss rules are putting a bit of a damper on things.
Totally. And remember, even if you can't deduct the full amount right away, those losses are still carried forward. So it's not like you're losing out on the benefit. It's just a matter of timing.
Got it. So let's talk about the elephant in the room, the cost of actually having a cost segregation study done. What are we talking about here?
Well, as you might expect, it varies. For smaller residential properties, it might be a few $1,000s. For larger commercial buildings, it could be significantly more. The important thing is to do the math, weigh the potential tax savings against the cost of the study, and, shop around a bit, get quotes from a few different qualified firms.
Makes sense. So essentially, it's an investment. You're paying up front for the study, but the hope is that those tax savings will more than make up for it, right?
Absolutely, especially over the long term. And the sooner you do it, the more time you have to reap those benefits. Plus, as we mentioned, you can often apply cost segregation retroactively to past purchases or renovations. So even if you've owned a property for a while, it might not be too late to explore this.
That's interesting. So let's bring this to life with a real-world example. Can you paint a picture of how this might play out for, say, a single-family rental property?
Sure. Imagine you buy a cute little rental house for, let's say, $525,000. Half of that is for the land, so you've got $262,500. That's the actual building value. That's what you can depreciate.
Okay, so $262,500 to work with.
Now, if you just depreciated that over the standard 27 and a half years, your annual deduction would be a little over $9,500. Not bad, but not exactly a windfall.
Not exactly life-changing money.
But let's say you do a cost segregation study. They identify $50,000 worth of personal property stuff like appliances, carpeting, window treatments that can be depreciated over 5 years. Plus, another $30,000 for land improvements like the driveway and landscaping, depreciable over 15 years. That leaves you with about $182,500 for the remaining building structure, still on that 27-and-a-half-year schedule.
So you've essentially shifted $80,000 of that value into much faster depreciation schedules.
Exactly. And here's where bonus depreciation comes in. Remember that $80,000, the personal property and land improvements, might be eligible for a hefty bonus depreciation deduction right now. Let's say for this example, you can deduct the whole thing in the first year. That's $80,000 off your taxable income right off the bat. Plus, you still get the regular depreciation on the remaining building value, which is about $6,600 for the first year.
So we're talking over $86,000 in depreciation for year one alone, compared to just over $9,500 without cost segregation. That's a huge EE difference.
It's a real game changer, isn't it? And if we factor in a typical tax rate, let's say 24%, you're looking at over $18,000 in additional tax savings in that first year alone.
Wow. That really puts it into perspective. So the bottom line is cost segregation can be a seriously powerful tool for real estate investors of all levels. It can accelerate your returns, improve your cash flow, and reduce your tax burden, even if you're just starting out.
Absolutely. It's definitely something worth looking into, even if you've owned properties for a while. The key is to consult with a qualified tax professional. They can analyze your specific situation and help you determine if cost segregation is right for you.
Solid advice. Because navigating the tax landscape can be tricky, to say the least.
Well, sure. It's always best to have an expert in your corner.
Well, that's all the time we have for today. But before we sign off, here's a thought for you to ponder. If you could free up significant cash flow in those crucial early years of property ownership, what could you do with it? Could you reinvest in upgrades, acquire more properties, or just breathe a little easier knowing you've got that financial cushion? Something to think about.
Great question. And with that, thanks for joining us for this deep dive into cost segregation.
See you next time.